Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding, the #1 value investing podcast in the world. Sitting next to the co-founder of the #1 value investing podcast in the world, Geoff Gannon, sipping his iced coffee, Death Wish iced coffee. How's it going today?
It's going very well. I just realized that our illusion here is going to fall apart because although we're wearing different clothes, they're going to be on track when we recorded by the fact that we have the same drinks and stuff.
That's right. We're drinking the same exact stuff. You got your iced coffee.
Order,
I got
it's
Starbucks.
Fill up more over time.
They know the secret. We hope everyone is doing well out there. If you're listening on YouTube, hit that subscribe button, thumbs this video up. If you are listening on the podcast side of things, a rating and review goes a very long way. And we are very appreciative of that. So in today's podcast, we're going to talk about what we tried talking about yesterday before my computer crashed. And it was incredibly deflating. And we just can't do two topics right after each other if we mess up. We got I call it the blue screen death. I don't even know what you want to call it. I mean, it's just absolutely terrible when you're recording like 15 minutes in and then you get that. But let's talk about the actual time when it's like time to, purchase a stock and pull the trigger. So we've been talking a lot about decision making. We were talking about thinking in bets. And at what point in the research process is it, like you feel comfortable enough where you've learned enough where it's an interesting buy and you want to actually purchase a stock? Is it after, talking to management? Is it after doing like some channel checks? We've talked about before how sometimes the best ideas you kind of know about really quickly, and then it's just really doing some fact checking after there. So what's that process like for you?
It depends on the company. And you've worked with me now seeing how I do these things. It really is that I have some specific questions that are important to have answered and I don't know the answer to. And usually I have guesses. That's usually the way that I do it. Actually, I would say that's one of the biggest differences between how I do a lot of these things and how people are talking to me do it, is that I, as strange as it sounds, I follow the procedure that I guess, was it John Malone mentioned? The key to doing, I think it was John Malone mentioned, that the key to doing a lot of math things in financial things is to immediately have a guess. You just guess at the answer first, and then that helps dealing with things that you then actually solve the problem from there. But I do that with all sorts of things by here's some thing that's odd about the situation. Why do I think this is happening? And then look for confirmation of that or things that might prove a different possibility. And sometimes I actually use more than one guess. So this is not like strictly the scientific method. I'm testing one hypothesis at a time. But I might have guesses like, okay, so customers aren't switching because they don't know that there are other alternatives. Customers aren't switching because it's kind of a big pain to switch these things, or customers aren't switching because this is so superior to the other product in this industry in a way I, an outsider, can't possibly recognize, things like that, So sometimes there's something weird about it and we need to know the answer, and we can't find the answer. So I looked at a company once, it may not even be still a publicly traded company. It definitely ran into some problems. That was in an industry where I was looking at a few competitors, and these are companies that provide mobile temporary power sort of things. Although the argument about how temporary is an interesting question, because in some emerging markets it's not very temporary. It's used for long periods of time. But so they could supply it for, you have an Olympics, and so you have power for that. But it also could be that you're doing things that you have mining operations and drilling for oil and things where you need power out in different places. It could be because you're putting your army out in some places they wouldn't normally be, and so they need temporary power. So looked at things in this industry and we figured, okay, so why do they make the decisions they make? And we made some guesses. Okay, so what would be useful to me if I needed temporary power? Well, the most efficient from like a perspective of just how, so what fuel does it run on and stuff, but then just the efficiency in terms of how much does it waste versus how much does it actually turn into power for me. So that kind of stuff is sort of a very easy to Wikipedia and talk to people and stuff physics problem, basically. It's very simple to figure out like what is actually more efficient. We can look at like a nuclear power plant and a generator that you'd have in your backyard and see that one is a lot more efficient in turning it into power than another that you're using. But you may not need all the power from a nuclear power plant. And so the question of how big a block of power do you have to put on at one moment? So if you're turning on and off things all the time, the efficiency is going to be dramatically different. So we looked at that and stuff. And there was this one company that stood out in that it didn't score very well by any logic we could figure out. and what it was doing. It was doing something that we thought didn't make a ton of sense. And so we tried to talk to people about it, and they gave us sort of odd answers to it. And I mean, my best answer to it probably today, trying to look back and figure out what was happening, is that I think there was an incentive from GE sort of to sell this product. And I think the GE name in certain countries and stuff went very far and things like that. That helped with this. But it was talking to people and trying to figure out what they were doing. And to a certain extent, the customers, what they were doing didn't seem rational enough to us to have a lot of faith in it. That they sometimes chose a product that seemed to us inferior to the competing products was a real concern. Whereas in the case of some other companies, it made a lot of sense why they were choosing it. And so if we needed to know why are they choosing this product, and we can't tell that what they're doing makes a lot of sense, then we couldn't buy into that company. And so even though that company was a lot cheaper in many ways and stuff, we decided not to do it. And we had some guesses about things that maybe didn't make a lot of sense. Mm-hmm. But what we recognized was that there was a problem here where this thing that didn't seem to be the superior product was being adopted by people. But in other cases, when someone is adopting a product that doesn't seem to be the superior product to us, it's fine if there's sort of illogical but very human reasons why they might be doing that. And so then we're okay with it. Even if it's just things about the brand's been around forever and, it doesn't cost that much and in terms of money, but a mistake here would be really bad. So we just go with what everyone's always used since the beginning of, this technology or whatever. Makes perfect sense to us, and we could understand that. So it depends on figuring that sort of stuff out. You figure out what's sort of the critical things that make a difference in your valuation. And sometimes it's very, very simple. How do we pull the trigger on should we buy or not buy Maui land and pineapple? There's only a few questions, Mm-hmm. Basically, the most important question is how confident are we that the land is worth X per acre? Mm-hmm. So, they sold some stuff recently for close to $1 million an acre. And
from doing our scuttlebutt too, we don't own MLP,
right.
Full disclosure, but we have in the past. And when we did do it, I forget what the market was pricing it at, maybe less than 300,000 per acre, maybe in that area.
Yeah, it might have been at 300,000 acre when
all of our scuttlebutt said, hey, if you could buy a piece of land for less than $400,000, you better buy as much as you possibly can because it's north of $600,000 per acre.
Yeah. And then there's been some that's been sold at that level or higher. So that's important. And then the other thing is a question of, is there any way they could end up issuing stock, doing things that would dilute it? And then eventually, when do they actually monetize this? The when do they monetize is somewhat less important if they're if it's growing at a pleasing rate underneath. And land in Maui actually over long periods of time has compounded in value. Whereas say, some other things, timber in some parts of the country and stuff where there's some G&A expense might not be, So it depends on that. But that is almost the entire factor there. And so if that's big enough, if let's say it gets to a price where it's at $200,000 an acre, and you're seeing comparable sales of things, and there's almost nothing comparable there, going for $1 million an acre, that's a big enough margin of safety that's basically all you need to know, as long as you know that people aren't crooks and things, or that there's no chance they'll ever do anything with the land. But they have a plan, in place that they plan to develop, but whether they ever do or not, they have a plan. So you if you have an 80% margin of safety, that's probably enough. Now you'd also check, is this some insane bubble that doesn't make any sense? I mean, there's probably some land in Japan, which is not more valuable now than what it traded at in the late 1980s, but it traded at kind of crazy prices there.
What percentage of information do you think you normally have? So let's say if you could know 100% about a stock, everything there is to know, what percent do you think you normally have going into it and still have the confidence to buy it? Does that make sense?
Yeah.
Because if you had 100% of the information that you wanted, the opportunity probably would not be there. Mm-hmm. So if you had to, I guess, measure it.
It's hard to answer that question. It's a thing to think a lot about what does information mean and stuff, like that. And I would recommend the book Fortune's Formula on that topic. I think it's very rare for it to matter. I think depending on the quality of what we're talking about, the information, talking about a bit of information or something. If we could have a bit of information at the highest degree of confidence, I think that 5 bits or fewer would be all that's needed to make almost any investment decision.
Okay, what does that mean, 5 bits?
So 5 pieces of information. And that gets into the complication of how do you communicate that information. And the information in many cases, the information can only be understood by certain people. So the same thing, the same 10K read by me and read by someone else, depending on our knowledge of the industry and some other factors like that, is tremendously different. For example, there was a situation in which a company kept saying that as a risk that it might issue equity. Now, I became convinced, could be rightly or could be wrongly, based on the past, that there was very little chance this company would ever issue equity. A couple different people told me that they liked things about it, except that it would probably issue equity because they wouldn't take this out of their 10K.
Sure.
I, knowing stuff about 10Ks and then the stuff about what people actually say and do versus what's in there that the lawyers had in 10 years ago or whatever, felt that was meaningless. And so felt that other things were telling me they aren't going to issue equity.
Like what? Management owning a lot of the stock?
Management owning a lot of stock, how deals in the past were structured, how deals in the industry tend to be structured, how management structured deals at other companies they were at, things like that. And so I thought it not important that there was a disclosure about that we may have to issue equity. That's a very, very common disclosure, especially with smaller companies and things. If they say they're going to acquire things, they almost always tell you that they might issue equity to do it. And some companies do and some don't. So that kind of interpretation does go into the information. And that's one of the things is like, how do you define information? The same thing means different stuff to different people, usually having to do with their knowledge of the context of what kinds of things they've seen before. And sometimes it is reading into the people and stuff like that, and behavior. And that can be a very big part of it. And some of it is reading to stuff about the industry. So those are very big factors. And it's hard to define like what that information means and stuff. We were talking about a good thing would be to use like, I talked about some of my highest conviction sorts of ideas or things. Mm-hmm. And one example of a high conviction thing that I did was buying into a insurance company. And I bought into this insurance company after it had been investigated by the SEC and after its auditor had dropped it. And to a lot of people, how can you have a high conviction idea about those sorts of things? But there were factors involved with the company, which I think if you had a good enough, a layman's investing, whatever understanding compared to a lot of other investors, despite not having any special knowledge of the insurance industry, I had enough knowledge of certain things that there were very strong signs that it was much safer than people might think with something where an auditor was dropped or there was an SEC investigation or something like that. And so it means you have to know a little bit about auditor things, I guess, a little bit about SEC investigations, and a little bit about like the industry that they're in and stuff like that. And so I may react very differently when people tell me one thing about a company that's under investigation, whatever, and another. And so I just took it as very differently than other people might. And so I had a high degree of confidence in it. But so like using the example of the information stuff, right? With that company, there were three pieces of information that were incredibly critical to me. So
is this the insurance company?
It's an insurance company. Okay. So we can talk about this. So this insurance company, there were three pieces that were overwhelmingly critical. So we can talk about the price and stuff. Okay. So price, you could say whatever you want with that. Half or less of book value probably at the time and 5 times earnings or something. All right, fine. So that's information that's important. You need to know the price of the stock. But the three things that were very important to me in it are, one, its losses that it had then and at another time in its history were unrelated to the line of business in which it made most of its profit historically. And I've looked at some different insurance companies and stuff over time. That's an incredibly important piece of information. The same insurance company can lose a ton of money in something it's never written before as compared to something that's been writing for half a century and stuff. It's not hard to do. And it's not that hard for an insurance company in a lot of things, certainly in this thing, to pull out very quickly from that business, especially if it was a new business. They haven't actually written all that much, and they won't actually have it drag on for all that long. So that was very important, that this was not the core business what had gone wrong. So it's kind of like the American Express salad oil scandal, right? If it had been some scandal having to do with their credit cards or their traveler's checks, that would have been one thing, but it had to do with something that had nothing to do with where all their money came from. So it's a scandal that's something that doesn't have to do with the key parts of the business. But the other two factors that were really important were that it had, in that core business, basically had a history of underwriting profitability that was tremendously consistent for 3 decades. as compared to most insurance companies. So it had very high earnings from underwriting as compared to most insurance companies making more money from investment stuff, which has a great degree of confidence in terms of the book value thing, because the book value of an insurance company should only really be lower than the price to book, should only really be lower than 1 in cases in which the underwriting is sort of a drag over time.
Sure.
So if the underwriting is a plus, then you're basically getting some underwriting profit plus you're getting a portfolio. So why should the portfolio be worth less to me than owning it outright? Like if I'm buying a bond portfolio, or I'm buying an insurance company with a bond portfolio. If I'm buying an insurance company with a bond portfolio, and they also make 8 cents a share, 8 cents on the dollar of that portfolio every year in underwriting profits too, it should be worth book value or more. But then the other thing was, which is a very big factor for me, and also probably a big factor for AM Best, giving them a fairly quickly, or whatever you want to call it, not knocking down, or at least not keeping down their financial strength ratio for too long. And AM Best is kind of like, if you want to compare it to the Moody's or S&P for bond ratings, that's what they are for ratings for policyholder for the strength of an insurance company. It's a very important number, rating. So on that point, the really big thing was that they were not writing very high amounts of premiums relative to the business they were doing. And that's critically important to me. So like, that's a thing where I don't know if the average person looking at it cares. I don't even know what most things I read about insurance companies, they're not even telling me whether they're writing $3 of premiums for every $1 statutory surplus versus 50 cents for every $1. But it's incredibly different, because if you're writing 50 cents for $1, you can up that by a huge amount. Your regulator will let you, and you can suddenly be writing a lot more premiums. If you're writing $3 to $1, the moment you have a loss or something, you've got to pull back on your premiums, because they're not going to let you write $4, $5, $6 in premiums for every dollar in surplus. So I felt like, if this makes sense, and it's something Buffett said with like American Express or Wells Fargo, there's certain kinds of losses to a company that knock down their earnings and change the trajectory for the long term. And then there are other ones that are, as Buffett said about American Express, like they sent a dividend check out in the mail and it got lost. That's what happened with this company, because they would have written $1 in premiums, or let me put it this way. They would have written $1 in premiums if they had all that surplus. They lost half the surplus or something, they'll just write $2 in premiums against it. So they'll do the same level of business this year as last year. And that business is fundamentally the same thing. Yes, they had a one-time huge loss, but to me, that was like the American Express thing or something, right? But at some other companies and things, it's not. Like if the same thing happened to Progressive, it's not the same, because Progressive is pretty aggressive on its very conservative on investment, but pretty aggressive on its underwriting, really pushing the envelope. So if it badly miscalculates in underwriting, it can't really avoid pulling back, I would say, in terms of market share and stuff. The next year, it would have trouble doing that. And that's something that, like with insurance companies, with Berkshire, things that people miss is that Berkshire is able to greatly increase premiums at times because it's perfectly willing to write very low amounts versus what it could regulatorily. So
they just turn the knob.
Yeah. So in that case, what mattered? I don't know that more than a few pieces of information really mattered to me, though they did matter a great deal. And in that case, I waited, although there was a risk that it would be too long, to make sure that the SEC investigation was closed. So if I'd moved a little bit faster, it would have mattered. In that case, since it was such an illiquid OTC thing, I figured it didn't matter. Now, if that had been a mega cap stock, not moving before the SEC investigation closed would have been a big deal. And actually, it did cost me because I wasn't able to get the volume that I wanted. So I would have been better off buying before the SEC investigation closed. But I felt I didn't know enough about the SEC investigation and stuff like that.
Got it. So I guess if there's some key takeaways here, it's knowing sort of maybe 3 to 5 points that carry most of the weight, right?
Yeah. But the issue is that you have to know those things with a high degree of confidence.
Yeah.
And you have to know them, and sometimes they're related in ways that might matter. But so you have to know them with a very high degree of confidence. And calibrating that confidence, which you talked about in like when I talked about thinking in bets, is the most important thing. Most investment things people talk to me about and stuff, it's not that I necessarily disagree with what they think is going to happen or what they think they're seeing, but I just disagree with the degree of confidence to which they have that belief. And then I don't think you should bet so highly unless you have a very high degree of confidence. When you have 30 consecutive years pretty much of much higher profitability than the industry ever has, writing the same sort of business basically. That has a degree of confidence, I guess I could say, that to me is incredibly different than 99 out of 100 companies' earnings. My belief in the earning power there is so much greater than if you show me some retail or something. I would value that same dollar of earnings in terms of confidence in it from that business so much higher than I would from other businesses. And so when people are like, how do you compare a semiconductor stock at 5 times earnings and this insurance thing? There's just no comparison to me in the degree of confidence that I have in one kind of business and the other. And it's based on the history of producing those earnings.
And wouldn't you say it's other factors as well? Like if they have high customer retention rates or long-term contracts, I mean, there's other factors that help you come to that conclusion.
Yeah, absolutely.
Like Geico, for example, has incredibly high retention rates. And that's always a factor that we look for in a lot of companies that we analyze,
Yes, exactly. And also just in terms of, but a lot of things tell you all of that in one number, like profit margins and stuff. Combined ratio is sort of like a profit margin. It tells you 2 things, which are, yes, the predictability in terms of customer retention or that you're winning a big part of the business or whatever, but it also has to tell you something about your cost position. This could be the loss position more. It's what their loss ratio is more than the expense ratio. But it tells you something about the cost position in the industry, because there will always be some years in which some people in the industry overdo things. And so, like, take semiconductors. If there's Intel and it has a good long-term record, or Southwest Airlines in airlines, just by looking at the numbers, that there has to be something very special about their position relative to the industry, because some people are having losses and they're not. Geico and Progressive stand out in auto insurance because there are years in which everyone is having pretty meaningful losses and they're not. That tells you something that you then investigate, but it's something that must be very meaningful about their cost position relative to others.
So it's really like the why.
Yeah,
Keep
you have to ask that question
and figure out, the reason behind it.
Yeah, and it's helpful if you haven't answered that question. If you can't answer the question, which happens sometimes, then it's very hard to buy the stock. And we've unfortunately had that happen at times. So a lot of times I'm 80% of the way to buying the stock, even after reading the 10K or something. But I just need to know, and I'm obsessed with knowing the answer to some particular question that I don't know why that is. And in some cases, it might mean you have to meet management. It might mean you have to see something. You might have to test the product for yourself. You might have to talk to customers. It could be any of those things, depending on why there's something happening with it that you just don't understand. And the further you are away from the product and stuff, the harder it can be to do that. You have to get in the mindset of whoever the customer is of why they're doing this.
What are some things that you're trying to get from management, I guess, when we speak to them?
The biggest thing is a feel for management in terms of how they answer things, what their focus is on, if there are any big things that they might blow up or something like that. And just trying to get them talking that way. So sometimes you ask questions that aren't necessarily all that important, but I want to see if they answer things in a certain way, especially without tipping them off more to what we might be interested in. So like we've talked to a few banks, and in each case I've asked them a question about duration. I can look at their things and know what the duration is, and there's nothing they can tell me about duration that's going to surprise me. But the question is helpful in gauging how seriously they take things like investment risk and predictability of their earnings and stuff versus how seriously they take credit risk. And often their answer to that question has an overwhelming thing that they're focused on credit risk, which might even seem to them like not a good answer, or some people might think it a bad answer because you should also worry about risks in your balance sheet stuff. But to me is more important, because the fact is very few banks are going to fail from some mismatch that they have in terms of their assets and liabilities and stuff. Many are going to fail from credit problems. So if they keep talking about credit, even when I ask them that question about duration, it tells me a lot about them. And it's not an immediate thing. Like if I just ask them, how seriously do you take credit risk? They're all going to give me the same answer.
Oh, we take it very seriously.
Yeah. So if you give them something that's more like, why are you, that sort of thing, I think that's very helpful.
Yeah. I mean, we've done this a lot together. So I think it's really just asking the questions just to get their thought process on it. Even if, like I said, maybe you're asking sort of a softball question or a question that maybe other investors wouldn't ask, you're just really trying to feel out their mindset towards it and how they respond to it and how they think about it.
Yeah. Like
when we ask NACO about, their thoughts on return on capital employed.
Yeah.
And he says, well, for as long as I've been at the company, that's been the measure that we always use internally and blah, 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 blah. Right. I mean, I know what return on capital employed is. So some of the questions I'm asking them, I know the answers to it. I just want to hear their thoughts on it and their response to it. And if they're willing to give us this massive monologue and then say, does that answer your question? Or is there anything else? I mean, it's just really like how they say it, you know?
Yeah. And there's only a few key things that we need to know generally when we're talking to these companies. And so,
when I ask, sorry, not to cut you off, when I ask about the mineral rights, why do you disclose it? And they're like, well, a lot of people have asked. I mean, I understand that. I get that. But I just want to see like why, or like what their thoughts are on it, or how they're going to answer the question, stuff like that. And I don't think it's being deceiving. I just think it's trying to really feel out the way that they think about it.
Yeah, well, you want them to, I mean, not all managements will do this, but you want them to take it as a prompt to talk about the topic, not really that the question's all that important. Because we have a few things when we're talking about like bits of information. We have a few things that we really want to have an idea of what are they going to do, and how high is that confidence level? So for instance, you were talking to someone before, CEO of a company and stuff. And the truth is that while we had a list of 15 questions or whatever, overwhelmingly my greatest question would have been, what is the risk that this company issues stock at a low price, and how confident are we that they will not issue stock? How far do they have to get pushed versus everyone else? How bad does the situation have to get with being shut down and all that sort of thing before they meaningfully dilute at prices that we think would destroy a lot of value? You can't just ask them that question outright, but that's mainly a task of the question that you're trying to get answered, and especially the confidence level.
And because they're trained, if an equity investor is asking you that, to say, oh, we would never do that. You know?
Right. Yeah. But just questions about like, you know, what that is in there, and also under what conditions would they issue equity. So like, would they do an equity for equity, you know, a stock, 100% stock deal with a merger in their same industry, versus would they do it just to raise cash? You know, things like that. And so sometimes the way to get to that is more like, oh, well, how important is your dividend to you? Because if they're like, well, our dividend's not important as issuing stock, then they're telling you, we don't want to issue stock, we'll get rid of the dividend. But they're telling you, oh, our dividend is sacred. That could be a real warning that they'll issue stock, you know, because like to a REIT, they'll be like, oh, our dividend's sacred. And then they'll issue a huge percent of the company to keep paying that same dividend, you know? So it's those sorts of things. But there's usually only a few questions that we really need answered in great detail, in great confidence level that we have in it. So it's a few key points. Like in that case, the reason for that is that if you think you have a stock that's trading at a very low value, let's say Maui Land and Pineapple, if that was the example, that wasn't the CEO I was talking to. But if that was the case, it's very important that if they think that their land is worth a lot more than their stock is, they better tell you that they're not going to issue a lot of stock.
Sure.
You know, and so you have to have that with a huge degree of confidence. So then it might just be, what's the risk they're going to issue stock? How confident am I that they won't? What's the value of the stock? How confident am I that value of the land per acre? How confident am I in that? And it's that simple, you know, and then it's just the price. Like, what is that? That's 3 pieces of information or something? Yeah. That's all you really need with incredible confidence to evaluate a situation like that. That's an asset play, maybe a little bit simpler.
Got it. Cool. Well, I want to thank everybody so much for tuning in with Geoff and myself on the #1 value investing podcast in the world. If you're watching on YouTube, hit that subscribe button, thumbs this video up. If you're listening on the podcast side of things, a rating and review goes a very long way. If you want to help support and sign up for QuickFS, that is quickfinancialstatements.net, but actually QuickFS, just FS stands for financial statements. And you sign up, it's $35 a month. If you tell them you came from Focus Compounding, that gives us a commission. I want to thank everybody so much for tuning in with Geoff and myself, and we will see you in the next podcast.